Investing is a powerful way to build wealth over time, but understanding how your investments are taxed is crucial to maximizing your returns. The taxation of investments can be complex, with different rules applying to capital gains, dividends, and interest income. These rules can vary depending on the type of investment, how long you hold it, and your overall tax situation. Misunderstanding these tax implications can lead to unexpected tax bills or missed opportunities for tax-efficient investing. In this article, we'll break down the basics of how investments are taxed, explore the real-world impact of these taxes, and provide strategies for managing them effectively. Why taxation of investments is confusing. One of the main reasons investment taxation is confusing is because different types of income are taxed differently, and the tax rates can vary based on several factors. Capital gains. These are the profits you make when you sell an investment for more than you paid for it. Capital gains are classified into two categories, short-term and long-term. Short-term capital gains, from assets held for 1 year or less, are typically taxed at your ordinary income tax rate, which can be as high as 37% in the US. Long-term capital gains from assets held for more than 1 year are taxed at reduced rates, generally 0, 15, or 20%, depending on your taxable income and filing status. Dividends. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Qualified dividends are taxed at the lower long-term capital gains tax rates. Ordinary dividends are taxed at your ordinary income tax rate, which could be much higher. Interest income. This includes interest earned from savings accounts, bonds, and other interest-bearing investments. Most interest income is taxed as ordinary income, meaning it's subject to your highest marginal tax rate. However, certain bonds, like municipal bonds, may be exempt from federal and sometimes state taxes, making them more tax efficient. Other factors: holding periods. The duration you hold an investment can significantly impact your tax liability. Holding an asset for over a year often results in more favorable tax treatment. Tax brackets. Your income level determines your tax bracket, which affects the rate at which your investment income is taxed. The real impact of misunderstanding investment taxes. Failing to understand how investments are taxed can lead to several costly mistakes. Unexpected tax bills. Selling an investment without considering its holding period can result in a higher than expected tax bill. For example, if you sell an asset you've held for less than a year, you may be subject to a much higher short-term capital gains tax, which could significantly reduce your net profit. Missed tax-efficient opportunities. Not taking advantage of tax-efficient investment strategies can result in paying more taxes than necessary. For example, holding on to investments for longer periods to benefit from lower long-term capital gains tax rates, or strategically placing certain types of investments in tax-advantaged accounts can reduce your overall tax liability. Impact on investment decisions. Tax implications can and should influence your investment decisions. Without understanding these implications, you might make choices that are not optimal for your financial situation. For example, investing in dividend-paying stocks without considering your tax bracket could lead to a higher tax burden than expected. Managing and reducing investment tax liabilities. To navigate the complexities of investment taxation effectively, consider the following strategies. Tax-efficient account placement: place investments that generate high taxable income, such as bonds or dividend-paying stocks, in tax-advantaged accounts like IRAs or 401(k)s. This defers taxes until you withdraw funds, potentially at a lower tax rate in retirement. Place investments that benefit from lower long-term capital gains tax rates, like growth stocks, in taxable accounts. Utilize tax loss harvesting. Tax loss harvesting involves selling investments that have lost value to offset the gains from other investments. This can reduce your taxable capital gains, allowing you to lower your tax bill. Any losses that exceed your gains can be deducted against up to $3,000 of other income, with the remainder carried forward to future years. Be mindful of holding periods. Before selling an investment, consider how long you've held it. holding an asset for more than a year can qualify it for the lower long-term capital gains tax rate, which could significantly reduce your tax liability. Consider the timing of sales. The timing of when you sell investments can impact your tax bill. For example, selling investments in a year when your income is lower could reduce the tax impact. Additionally, deferring the sale of investments until you're in a lower tax bracket, like after retirement, could also result in a lower tax rate on your gains. Invest in tax-advantaged securities. Municipal bonds are often exempt from federal and sometimes state taxes, making them an attractive option for investors in higher tax brackets. Consider investing in index funds or ETFs that are tax efficient due to their low turnover rates, resulting in fewer taxable events. Understanding the taxation of investments is essential for making informed financial decisions and maximizing your after-tax returns. While the complexity of different tax treatments for capital gains, dividends, and interest income can be daunting, being proactive about managing your tax liabilities can lead to significant savings. By utilizing tax-efficient strategies, staying informed about tax laws, and considering the timing and type of your investments, you can reduce the impact of taxes on your portfolio and achieve better financial outcomes. Investing wisely is not just about picking the right stocks or bonds. It's also about understanding how those investments are taxed and taking steps to minimize that burden. As tax laws and rates can change, it's crucial to stay updated and consider consulting a tax professional to optimize your investment strategy. Please subscribe and hit that notification bell.